we saw an earnings miss here from Meta, the company reporting $1.64 in earnings per share versus estimates of $1.89 in earnings per share. But Meta revenues did beat estimates, coming in at $27.71 billion versus $27.38 billion. So to put that in context, analysts were expecting Meta to have its revenue decline by about 5.5% from the year ago quarter. Instead, the revenues declined by about 4% from the year ago quarter. So not quite as big of a decline as expected. Just going through some of the key details here, monthly active users on Facebook increased 2% year over year. Daily active users on Facebook actually increased 3% year over year. That's slightly better than expected. Since there's a lot of attention over the price per ads, they say the number of ad impressions increased by 17%, while the average price per ad decreased by 18% year over year. In terms of some of these other key factors here, I'm going to dig in to the commentary here, but they do guide to fourth quarter total revenue to be between $30 and $32.5 billion. So analysts had been looking for fourth quarter revenue of $32.3 billion. So that range is slightly lower than the consensus of analysts, but within the range. And they say they're assuming foreign currency will be approximately a 7% headwind. So they're talking about the budgets, and they're going to hold headcount flat between where they are right now for headcount through the end of 2023. So, Scott, this is really essential here. We're talking about layoffs. We're talking about hiring. They're saying we will not add any people to the overall headcount between where they are now and the end of 2023. So I'm going to continue to dig in here. There's a lot more, but I want to let you guys digest this a little bit.
Yeah, appreciate that very much. And we'll look forward to hearing from you, Julia, in a moment. So, Stephanie Link, I want your review of this. So revenues declined 4%. User growth is slowing. And it has been. And headcount's going to remain flat. No talk of reducing headcount when you have, Altimeter, again, just to let everybody refresh their memories here, was calling for a 20% reduction in headcount.
This probably doesn't change the Bulls or the Bears, to be honest with you, right? Earnings were a disappointment. Revenues were a little bit better. I thought DAUs were a little bit better, up 3%.
Rev guide light, though, or to the lower end of that range. And that's when the stock, we're talking about a 15 or 16% turn in the stock. Remember, right off the bat, up 8%. Now we're talking down almost 8%.
It's early. The expense guide that I'm looking, it says 85 to 87 billion for the year, and that was a little bit better than expected. 85 to 89 billion is what people were kind of expecting. So they're lowering that range a little bit. We'll have to hear what they have to say on the call, but I think that's actually a positive as well. So look, we'll have to hear what they have to say, but I'm shocked that the stock is down as much because it's already been hit so hard.
Can we look at? Can we get a chart of Snap up?
This is not Snap. I'm sorry, but this is nowhere near Snap.
Hold on. I'm about to make a point that I think you're going to high-five me on. We have a tendency when we do these earnings things, like the next day, it's like, all right, what's next? Take a look at what Snap has done in the last 2 days. This stock was almost $6. It went back to close to 10 today. There have been stories like this where, okay, the news was bad, but it's too much. And you've had big snapbacks in the following two. Here's Snap, 9.5. This was almost 6. Like a couple of hours ago. So I would not look at a company that reports earnings, quote unquote, disappoints, has already been cut in half, and just dismiss it like, all right, that's over for 90 days. There could definitely be a bounce here.